So guys, I think by now you have a beautiful understanding of what corporate actions are and their impact on the share price. Now we are coming to the last corporate action that we will speak about, and that is known as share buybacks. In a way, a share buyback is opposite of a rights issue. In a rights issue, company issues stocks to generate capital so that they can grow. But in a share buyback, company use their own capital to buy back the shares from the market. Now, why do companies do that? What does it even mean? Don't worry, we will talk about all that in today's episode. Now, what are share buybacks? In a share buyback, a company buys back its own shares which had been issued earlier. Now, the repurchased shares are absorbed by the company and the number of outstanding shares in the market basically reduce. Now, since the number of outstanding shares reduces, the ownership stake of any investor who doesn't sell his shares increases. Now, there are two types of buybacks. First buyback is a tender offer. Now, in a tender offer, shareholders have the option to submit a portion or all their shares within a certain time frame at a premium to the current market price. Now, this premium compensates investors for tendering their shares rather than holding on to them. Now, let me give you an example. On 15 Jan 2021, GAIL India announced a share buyback worth 1046 crores, right? 1046 crores. Now, this means shares worth 1046 crores were bought by the company. Now, the buyback price was pegged at 150 rupees per share, while the market price was at 138 rupees per share. Now, this offer opened on 25th Feb and closed on 10th March 2021. Now, the second type of offer that we will look at is an open market offer. Now, companies buy back shares in the open market over an extended period of time. This means that you can't tender your shares and the company just buys the shares from the open market through the stock exchange. Now, in June 2021, Infosys announced a share buyback through this route. The buyback period was much longer as compared to a tender offer, from 25th June 2021 to 24th December 2021, and the issue size of the buyback was 9,200 crores. Now, the buyback price was a maximum of 1,750 rupees per share. This means that Infosys would buy shares on the open market at prevailing market price, provided it does not exceed 1,750 rupees per share. Now, what is the impact of a share buyback on the share price? Now, if a share buyback happens through the open market route, then there is a sudden increase in demand that may cause the share price to go up. The second thing you need to consider is what we mentioned earlier, that after a buyback is over, the number of shares of a company reduces. So let's say that there's a company that had 100 shares, okay, and the company did a buyback for these shares. Now, if the company buybacks 10 shares of the company which had 100, you buy back 10 shares, then the total number of shares remaining in the market is 100 minus 10, which is 90. Now, when the shares reduce in the market, the earnings per share, which is nothing but the net profit divided by the total number of shares, will obviously go up, right? Because number of shares went down. Now, when the earnings per share rises, investors might be willing to pay more for that particular share, which may increase the share price as well, and the share price might go up. Now, let's understand, why do companies go for a share buyback? The first and the most basic reason that companies do a buyback is to return the cash back to investors. Right? There will be investors who have invested in this company for a very long time, and the buyback can help them sell some or all of their shares. Now, in this way, a buyback is similar to a dividend in terms of returning cash back to investors. Now, sometimes companies buy back shares if they feel that the stock is undervalued. The fact that a company uses its own money to buy back stocks around the prevailing market rate shows the confidence of the management in the company, and hence may prompt other investors to go and buy the shares of this company. Now, there are also cases when companies buy shares to improve some financial ratios. Now, we have already explained how a share buyback inflates the earnings per share of a company. The second ratio that is impacted by a buyback is the return on equity. Yes, a return on equity is calculated by dividing the net profit of a company by the total shareholders' equity in the business. It is a metric used to calculate the profitability of a business. The more, the better. Now, when a company uses its equity to basically buy back stocks, it causes the shareholders' equity to decline. This results in a higher return on equity as a result. Now, investors like you and me should analyze why the company is buying back shares. Now, generally, if a company buys back stock to artificially inflate some of the financial ratios, it's not a good sign. It would be better if the company invests this capital in order to grow and expand instead, right? Now finally guys, coming to the conclusion, we come to the end of the corporate actions. Now we saw all the corporate actions. Now I hope next time when you look at something like a dividend or a buyback or a bonus, you will be able to exactly identify why this company is doing it and what would be the impact on the company and the share price. In the next few videos, we will talk about the different ways in which you can analyze and select which stocks you want to buy or sell. So I'm going to see you guys soon. Great stuff.